Well, good morning. Hello and welcome everyone to this presentation to introduce the new insured option to the Blackfinch IHT service. It's nice to see some familiar faces have joined us, so thank you very much, and some new ones as well. Welcome. My name is Gordon Pugh, and I'm the Investment Director for Real Assets here at Blackfinch. Before we begin, I'd like to remind you that this presentation is not to be relied upon, and any decision to invest should be made on the basis of the information contained in the product brochure and terms and conditions. Furthermore, this investment is classed as high risk by the FCA. This means that you could lose all the money that you invest. You are unlikely to be protected if something goes wrong. The FSCS does not cover poor investment performance. The FCA highlight that as this investment is in an unlisted business, you may find it difficult to get your money back quickly. They also highlight the risk of not diversifying amongst different businesses and investments. And finally, they highlight dilution risk as the main company continues to attract further external investment. We will look at some of those risks later on, but first let me introduce you to the investment suite of Blackfinch. In the tax efficient investment space, here at Blackfinch, we do not have a bias on one method of solving a tax problem over another. That is to say that we offer business relief solutions in the form of unlisted, which we'll be focusing on today, as well as listed solutions through AIM. We also offer tax reliefs through EIS and VCT investments, as well as a corporate solution for those seeking business relief and business assets disposal relief. All this, as well as offering mainstream investment services through Blackfinch Asset Management. So this is a CPD session. I'm glad to say that we won't be keeping you here all day. We'll keep it nice and short and sweet and to the point. But today's learning objectives are that by the end of this session, attendees will be able to summarize what business relief is, how it benefits inheritance tax planning, and the key eligibility conditions and regulatory requirements for claiming up to 100% relief. Identify who business relief is suitable for, when it may be used, and where it fits as a planning solution. Provide an overview of eligible investments and investor criteria for the Blackfinch Adapt IHT Insured Service, and outline the health declaration requirements and the claims process in practice. Before we tell you about the new insured option, let's have a quick look at what is attached to and a brief overview of business relief and the Blackfinch Adapt IHT service in its current form. So, business relief was introduced in 1976 in order to try and help reduce the number of companies folding after the death of the principal owners. Over time, the legislation has been expanded and adapted to its current form, which allows investors who have held shares in BR qualifying companies for at least 2 years and continue to hold those shares on death to benefit from 100% inheritance tax relief on those shareholdings. This includes companies listed on AIM, and those can also be held in ISAs, giving further tax reliefs. In the 2024 budget, it was announced that there will be changes to BR, introducing thresholds for individuals and limits on the amount of relief that will be available to investors from April this year, April 2026. Thankfully, through a government press release, the threshold levels have been amended, and so going forward from April this year, the changes are that AIM qualifying investments will attract relief at 50%, meaning that there may be a 20% inheritance tax to pay on these types of investment. There is no threshold for these investments, and so it will be a fixed level of relief. For unlisted business relief qualifying investments, such as the service we are about to talk about, there is a threshold of £2.5 million per person, which is transferable between spouses and civil partners. So this means that married couples can invest up to £5 million in unlisted business relief qualifying investments and receive 100% relief against IHT on those shares after 2 years. Investments above this amount will attract relief at 50%, meaning that there will be an inheritance tax charge on amounts over £2.5 million per person, £5 million per couple, and that will be at 20% inheritance tax. So the budget announcements weren't just limited to business relief when considering inheritance tax, and many of you will know this already, but they will also target pensions from next year, from 2027. And as you can see, this has had a tremendous impact on the forecast for IHT receipts and highlights the growing problems for families and their estates and their need to find good quality advice from the likes of yourselves. So, in considering how to best mitigate the effects of inheritance tax, here you can see some of the options available to individuals. They can give their money away or put it into trust, and provided that they live 7 years, there's no inheritance tax to pay. Alternatively, they can pay for life assurance in order to perhaps help pay that IHT bill. And finally, the other option really is that they can invest into business relief qualifying companies. Now, all of these methods have their own pros and cons, and obviously it's about trying to find the best overall solution for a particular client. So, whilst gifting money away or putting it into trust doesn't have any inherent investment risk, the time taken to achieve a beneficial IHT outcome is the longest, and this brings time risk into the equation depending on the health of the individual. Furthermore, it reduces the asset base of the client. Life cover can give an immediate benefit, but can become expensive over the long term, or if cover is sought too late in life, again, it can be expensive. Business relief introduces investment risk, but also benefits from a smaller time frame to gain IHT exemption than gifting. And it also allows the client to keep control and access to their assets, which may be preferable to losing that access and control, as is in the case of gifting and trust. And we particularly see that for people who don't know how long they might live and might need access to their capital, maybe for long-term care needs later on. The new addition to the Adapt IHT service sees the combined approach of using life cover and business relief to give a belt and braces approach to IHT planning, whilst keeping life cover premiums to a couple of years. I'll explain all of this a little bit later on. Some of the ideal clients for this type of service may include business owners who may already qualify for business relief and are looking to sell their business. There is a replacement provision within the BR rules which allows them to maintain their qualification status without having to go through the 2-year qualifying period again if certain criteria is met. Business relief investments can also be suitable for power of attorney cases where gifting is not an option. With a short time frame to IHT exemption, BR investments are used by many elderly or ill clients. The BR investments can also be used very effectively within trusts, and our business development team can guide you through some examples if you'd like some further information. Finally, as mentioned previously, BR investments are great for those people who want to protect assets from IHT, but also do not want to give their assets away or lose control and access. So now onto the product, and firstly, we'll have a brief overview of the investment strategy before we get onto the new edition. Probably the most important attributes of an unlisted IHT service are centered around predictable, stable returns that are asset-backed. There are a number of risk management techniques that we put in place and we can put in place which go a long way in order to achieve these attributes. Clients investing into the Adapt IHT service invest into a group company called Buckley Trading Group Limited, which then deploys capital across a number of trading activities. These include investments into renewable energy products, where we only invest into the tier one technology of wind farms and solar farms. The use of these two different technologies means that we benefit from consistent energy sales across the year, with solar providing more energy in the summer and wind providing more energy in the winter, giving that predictable income annually. We also lend to borrowers, securitizing our loans against their property assets. We always lend as a senior lender so that we are first in line if the borrower gets into financial difficulty. This is why we always insist on having a first charge over the assets that we are lending against. We typically take personal guarantees from the borrowers to further protect ourselves. In 2024, we introduced commercial forestry to the portfolio and have continued to expand and diversify the trading activities, adding in leisure with hotel development and operation, home building, and joint ventures in energy development and pension services. This helps create diversification across many individual deals and assets, as well as diversification across sectors. You can get an idea of the level of diversification by this map of our assets across the UK, meaning that we also have a level of geographic diversification as well. All of our assets are based in the UK mainland, thereby negating any foreign currency risk, country risk, and political risk, as well as ensuring that our assets are located in much more accessible areas than some others. We like to keep it as simple as possible and as robust as possible from a tax and business relief perspective. Our IHT service is one of the few out of the main providers who ensure that we have no foreign asset exposure. We have three core objectives when it comes to the Blackfinch Adapt IHT service. Firstly, that the trading activities that we undertake are qualifying for business relief. Secondly, we believe that clients looking to invest in an unlisted BR service are focused on preserving the wealth that they have created and accumulated, and this is delivered through stability and low volatility. And as I mentioned, I think the most important attributes of an unlisted IHT service are centered around those predictable, stable returns that are asset-backed. Most of our clients are more elderly, and we believe that having built their wealth, they are interested in preserving that wealth and minimizing volatility in their IHT planning. So, on to the main point of today's presentation, and that is to introduce to you the new addition to the Adapt IHT service that I just summarised. We've been able to negotiate a group policy which covers eligible members of that policy to have a sum assured to help with any potential IHT liability should they pass away during the first 2 years of making their investment into the Adapt IHT service, whilst they wait for that shareholding to be able to be exempt from inheritance tax. This is a 2-year life cover which can be taken at 2 different levels of cover. There is a choice of 20% or 40% cover if the investor were to die within 2 years of investing. For most clients, they'll take the 40% option, covering the entirety of the potential IHT liability for the first 2 years. The 20% option is likely to be most suitable for investors who are transferring over investments from BR qualifying AIM shares, where their IHT exemption is likely to be limited to 50%, meaning that they can cover the 20% potential IHT liability whilst they wait 2 years for their investment in the Adapt IHT service to provide 100% exemption from IHT. And we'll go through some of the rules around that a little bit later. The sum assured maximum payout is £400,000 per person, meaning the sum assured can be up to £800,000 on a joint life basis, second death. This is a bolt-on option to the BR investment and will pay out regardless of whether the investor has an IHT liability or not, should the investors take the option. That is to say that the cover is for a specific sum assured and is only linked to the initial investment amount, not the investment amount at the time of death. The clients will have two single annual premium payments, with the first being taken from their subscription amount and the second being taken a year later from their investment in the Adapt IHT service. There are no premium increases if a client moves into a higher age bracket throughout the period of cover, and they have the same investment strategy as the uninsured Blackfinch Adapt IHT service. On a single life basis, the first 75 calendar days are covered for accidental death only, for example, being hit by a bus. After 75 calendar days, coverage is comprehensive for death by any cause. On a joint life basis, full coverage is immediate and any payout is based upon the second death of the eligible members. Individuals making investments into business relief for the first time and wish to have a belt and braces approach to IHT planning are the obvious target market for this product, whether that is on a single or joint investment basis. However, the cover may also be appealing to those who are already familiar with BR investing. Any client who may be partially through their 2-year qualification period may find that the cover gives added peace of mind that their investment amount will pass on fully by having cover in place. Investors who currently have AIM portfolios, as we mentioned earlier, may also find cover appealing, as from April this year, AIM investments will attract IHT relief at 50%, meaning that if they pass away after April, they may have to pay 20% in inheritance tax. So I mentioned earlier that there is a replacement provision so investors can move between one BR investment and another without any loss in relief. There is a caveat to that, and it is that the replacement investment cannot give more relief than the investment being replaced. So this means that if an individual and transfers from an AIM investment to an unlisted BR investment post-April, they will still be qualifying for business relief, but their relief could be limited to 50% during the first 2 years of holding the unlisted business relief investment. To counteract this short-term deficiency in relief, we offer cover at 20% of the investment amount as well as the full 40%. This cover is not available to existing clients within the Adapt IHT service, but please do speak to your business development manager and they may be able to help offer you a solution if any of those clients have a requirement for that cover now. Cover is available for clients on a single or joint basis, as mentioned, for those aged between 50 and 89 years old. The application form is relatively simple and there is no requirement for a medical examination or complicated health questionnaires. Instead, investors need to complete a straightforward health declaration stating that they have not been diagnosed with a terminal or life-limiting illness or not undergoing related investigations. And if they are over 70 years old, they need to declare that they have not had a stroke or transient ischemic attack or similar. The cover is available through power of attorney applications as well, which is a key differentiator for us. So to summarise which clients may consider using the insured cover, it includes those who are looking for a belt and braces approach to mitigating their IHT liability with immediate effect. Investors looking to reallocate their funds that are partway through their 2-year BR qualification period, and investors who are reallocating funds from AIM portfolios and are looking to mitigate 20% potential IHT bill whilst they wait for their unlisted assets to go through the 2-year qualification period. And as mentioned, all available through power of attorney applications as well. So what does the claims process look like? So a beneficiary or representative notifies Blackfinch of the client's death and the potential claim. Blackfinch issues a death claim form requesting key details and any other, in case there are additional questions, we will then issue these, such as if there are circumstances around the death abroad. The documents are then sent to the insurer, who conducts due diligence and medical checks, then confirms whether the claim is accepted or declined. Blackfinch will then inform the beneficiary or representative of the insurer's decision, and if approved, the insurer pays a claim amount to Blackfinch as corporate trustee. Now, importantly, on death, the insurer will pay the benefit into the trust and not into the deceased estate. So that means it doesn't form part of the deceased estate, and therefore there's no inheritance tax on the payout. After completing due diligence, Blackfinch as trustee can use or lend the funds to the estate to help pay inheritance tax and/or distribute funds to the beneficiaries in the trust deed. The trust is irrevocable, meaning it cannot be cancelled once established. So we therefore strongly recommend that customers take independent legal and tax advice before signing the trust deed. If no beneficiary was named, the funds are usually paid to the deceased estate via the executor or administrator once probate documentation is received. The rates for cover based on the initial investment amount are as follows. I'll leave those up there for a short period of time. You can see we've got the fees for 20% cover, which of course are half that of the fees for 40% cover, and they're offered both on single life basis or on joint life basis. And we believe that for the level of cover against some of the competition, that they offer very good value for money in this marketplace. Now I'm going to finish off with a rather simple example, just to demonstrate how it may be used for clients. Here we have a client who invests in January this year, passes away in June next year, 2027. So therefore their investment in the Adapt IHT service wouldn't have gone through the 2 years and would not be qualifying for business relief. So on a £500,000 investment, there will be a potential £200,000 to pay in inheritance tax. Following a successful claim with the insurer, the named beneficiaries would receive a payout of £200,000, which could help pay HMRC for the inheritance tax, leaving the full value of the investment, £500,000, £500,000, to the beneficiaries. So in terms of the learning objectives from following this presentation, attendees can now summarise what business relief is, how it benefits inheritance tax planning and the key eligibility conditions and regulatory requirements for claiming up to 100% relief, identify who business relief is suitable for, when it may be used and where it fits as a planning solution, provide an overview of eligible investments and investor criteria for the Blackfinch Adapt IHT Insured Service, and outline the health declaration requirements and the claims process in practice. You should see a short feedback survey coming your way now, and we'd appreciate it if you could fill it out. It will allow us to send you your CPD certificates along with the product documentation later on this week. Thank you ever so much for taking the time to join us today, and please do get in touch if you have any questions. Thank you very much.